Just confirm for me if you're seeing my screen. Hello?
I'm able to see your screen.
Okay, so let's start. So today we're looking at the consolidated statement of profit or loss. So last week we looked at the statement of financial, what am I saying? Today we're looking at the statement of consolidated statement of financial position. Last week we looked at the statement of profit or loss, how to consolidate the statement of profit or loss. So for the most part in the exams, what's usually examined is the statement of financial position, the consolidation of the statement of financial position. Why? Because it's a bit complex. It's a bit complex because there's a lot that you need to do. But with the format that we have here, if you follow it, right, it's going to be easy for you to understand what you need to do, where and how. So that way, it's going to be not so difficult. So let's begin. Again, just like in the statement of profit or loss, we begin with the group structure. So we've got the parent here, and then you've got the subsidiary, which is 50% plus. And then you've got the associate, which is 20% to 49%. So you need to write this group structure using this V. So you've got the parent here like that. Then you've got the subsidiary here like that. Then you've got the associate there like that. And then you've got 50% here, right? And then here you've got maybe let's say 20%, like that. I know it's not very well represented, but that's how you're supposed to do it. So again, just like the statement of profit or loss, you start with the format, start with the workings, right? So the first working that you need to work on is the assets acquired. So what does the assets acquired have? It has got the value of assets at acquisition, the value of asset post acquisition, and then you have got what we call the post acquisition profit, right? So in the question, you will see when we go through the question tomorrow, you'll be given these things. So you'll be given the value of the ordinary shares, the share premium, retained earnings, revaluation surplus, right? And then contingent liability or even deferred tax, right? So all these ordinary shares will be given at acquisition. The moment you are acquiring this business, right? What is the value of these shares that you are buying in that business? Then also, what's the value of the share premium at the point of acquisition? So all this information you'll be given, even the retained earnings, right? What were the retained earnings at the point of acquisition? But at certain times where the business is acquired within the year, so you have to apportion, right? Right? The year's profit, right? So if let's say we are consolidating at the end of the year, and then this subsidiary was bought um, at maybe okay in June, right? So we need 6 months, right, to be included as part of the retained earnings before acquisition, and then the other 6 months, right, is going to be included as part of the post acquisition. So the other point that I need to mention here, what you are consolidating, just like in the statement of profit or loss, it's the parent and the subsidiary, not the parent and the associate. No, it's the parent and the subsidiary. So all these assets acquired at acquisition, we are speaking of the uh, we are speaking of the um, assets of the uh, subsidiary, right? Hello,
Oh,
can you get me?
yes, yes.
Okay, so yes, and then at the end of the day, you'll be given things like revaluation surplus, right? There'll be something like revaluation surplus. So at the point of acquisition, right, the assets that are acquired at acquisition, right?
Mhm.
Some are going to be revalued, right, to fair value, right? And then you're going to have what's called the revaluation surplus. So the revaluation surplus, you include it here, all right? And then you're also going to have what's called a contingent liability. So these, you don't have to stress about them because you'll be given these contingent liabilities like that. And then these contingent liabilities, it's a negative, right? And then you also be given deferred tax, right? So deferred tax is also supposed to be a cash outflow, right? My apologies, it's supposed to be in brackets. But how do we find this deferred tax? This deferred tax is on revaluation surplus. So you have to get the revaluation surplus minus the contingent liability, and then you multiply that by the tax rate, let's say maybe 30%, and then that's going to be a deferred tax liability here, right? That's if it's a deferred tax liability. If a deferred tax asset, that's if the revaluation, this was a revaluation loss, then you're going to have a tax asset. And then post acquisition, what do we have at post acquisition? So this post acquisition, these are all the figures in the statement of financial position, right, for the subsidiary. So the ordinary shares at the financial year end, as the figures are given, right, in the statement of financial position at the year end, this is what you include. You don't have to change anything. The share premium, right, in the statement of financial position, that's what you put there. Retained earnings in the statement of financial position, that's what you put there. Revaluation surplus as well, that's what you include there. So now this revaluation surplus, you'll be given depreciation that you need to charge. And the depreciation that you charge there, right, has to be deducted from the revaluation surplus, right? And then also, what happens here? You have to get the revaluation surplus, you deduct the depreciation, and then you also need to find the deferred tax liability, which you also have to deduct here. So you say revaluation surplus minus the depreciation, and then, for instance, if it's 30%, then you multiply by the tax rate of 30%, and then you're going to have the deferred tax. Then after you find these figures here, you need to find the difference between these two, right? The difference between these two is what we call A, right? And then A here, this is the post-acquisition profit, and then you have to multiply it by, let's say, 80% for the parent, 20% for the subsidiary. You're going to have, let's say, B here, and then you're going to have a C, which is relating to the non-current asset, the non-controlling interest. So now these figures that you find here, these figures, you need to take them somewhere. I'll show you where you need to take them. Hello?
I'm here. You can go.
Okay, so let's continue. Then number two, working number two, it's the goodwill, right? It's the goodwill. So how do we compute the goodwill? So number one, you need to have what's called the cash consideration. Here, the cash consideration is simply the amount that is paid in order to purchase that particular subsidiary. That's the cash. So here we're speaking of cash, right? But there's sometimes where we need to find what's called the share exchange. So sometimes you can be a share exchange. So instead of paying cash, this company decides to pay in form of shares. So let's say maybe one share for every 3 shares in the parent company, right? That's the ratio that we have here. So for a share exchange, you have to say the number of shares, right, that have been bought divided by the number of shares that are being exchanged, and then you multiply by the share price, right? The share price of who? The share price share price for the parent, because the parent, it's the one that's transferring the shares, right? And then you multiply it by the number of shares that have been acquired, right? And then you bring this here. I think here there's a bit of some doing to perform here. It's a bit of it's a bit tricky here. So explaining it by word of mouth is a bit of a challenge, unless we actually have a situation where we have a question that's relating to share exchange. But I think the question that we're going to go through is the one that has a share exchange. But what you need to do is you just need to understand the fact that you'll be given a ratio. Let's say maybe 2 shares are going to be exchanged for every 3 existing shares. Then you say 2 divided by 3 and then multiplied by the share price for the parent, and then you multiply by the number of shares that have been acquired. That's going to be the share exchange. That's the consideration that's paid in form of share exchange. And then there's deferred consideration. So deferred consideration simply means you pay some money now, and then you say in the future we're going to pay. So let me give an example. Let's say you're paying you're buying a business, let's say for 1,500,000, right, like that, and 10,500,000, and then you pay the 10 million, right, and then you say this 500,000 we're going to pay next year. So that's called deferred consideration. And then there's also what we call contingent consideration. So contingent consideration, uh, this simply means, right, you tell the subsidiary, the management of the subsidiary, you tell them, or the people that you're buying from, you tell them saying, okay, if the share price of this company grows to a certain amount, are going to pay you, right? So that's contingent consideration. So for the contingent consideration, what you need to do, right, you have to say the amount of money that you say that you say are going to pay in the future, maybe let's say 10,000. Then you have to divide by what's called the cost of capital, like that. And then that amount that you find is one that you bring here. Again, by word of mouth doesn't make sense unless you actually go through a question with this type of scenario. I don't know if you've got a question so far.
No, that's it.
Yeah. Then next, we need to say deduct. Oh, sorry. Then we have NCI, right? We also need to add the NCI to the cash consideration, share exchange, deferred consideration, as well as contingent consideration. So this NCI can be calculated in 2 ways. There's what we call the full goodwill, right? Then there's also what we call the partial goodwill, or maybe the asset-based approach. So the full goodwill, which is the fair value approach, this is where you say you get the share price for the non-controlling for the subsidiary, and then you multiply by the number of shares for the non-controlling interest. That's the fair value method. This is why you've been given the fair value of shares, right? So you get the fair value of the subsidiary, and then you multiply it by the number of shares associated to the non-controlling interest. And then you're going to find the figure that we're looking for there. But the partial goodwill, right? This one, what you do is you get the net assets, right? These assets that were purchased at acquisition, and then you multiply it by the non-controlling interest. In this context, it's what? 20%. So the figure that you find here at acquisition as assets that were bought at acquisition, you multiply by the non-controlling interest holding, and then you're going to have the share of non-controlling interest. That's the value of the non-controlling interest. And then when you add all these, you're going to have this figure. And then from this figure, we need to less the assets that have been acquired, which are these that we found in working number 1. And then we also have to deduct the impairment of goodwill. So goodwill impairs. You'll be given this impairment. There's nothing to think about or calculate here. These are figures that you'll be given, right? And then you've got Working number 3, property, plant, and equipment. Again, I'll mention this. What you're consolidating, it's the cash flows, or rather the items of the statement of financial position for the parent and the subsidiary, not the associate. So property, plant, and equipment for the parent, you get it and add it to the property, plant, and equipment for the subsidiary. And here we don't apportion anything. It doesn't matter whether the subsidiary was bought within the year, right? We do not apportion anything. So the way the figures are in the statement of financial position, that's the way you have to include them here. Then revaluation surplus, right? So what revaluation surplus are we dealing with? The same revaluation surplus that we had Apapana and Kane in the acquisition, right? So, but you need to deduct the depreciation. So the same depreciation that we had, working number 1 here, right? The same depreciation that we had here, the same one that we include to PPE. Then revaluation surplus, the same one that we include. Then the other thing I forgot to mention is depreciation, right? If the asset is bought within the year, you need to apportion it across the period over which this subsidiary was owned by the parent. And then if let's say there's a scenario where this subsidiary was bought maybe 2 years ago, this depreciation that you deduct here, it's supposed to be for 2 years. So you find the depreciation and then you multiply it by 2, right, to signify the fact that it's for 2 years, and then you deduct it from the revaluation surplus. That same depreciation, that's the one you bring up, right? And then unrealized profit on intra-group transfer of PPE. So sometimes property, plant, and equipment, right, is transferred across different subsidiaries, right? So if it's the way we have unrealized profit on inventory, we've got also unrealized profit on PPE, right? So the unrealized profit that you find, you also deduct it here. And then we also have investment in associates as working number 4. So working number 4, investment in associates, you get the fair value for the investment in associate. So usually the investment in associate, the fair value is just the amount that you pay, right, to acquire this associate, right? And then you say the share of profit. So what we know about the share of profit, the same idea holds here, right? If you've got a profit of 1,000, you multiply by the shareholding, which is maybe 20%, then you're going to have the share of profit. If that particular associate was bought within the year, you multiply that by 6/12. If it was bought on 1st June, right? And then you deduct unrealized profit. You also deduct the dividends that were received, and then you also deduct the impairment on what? On the associate. And then we're going to have this figure, and then you find the net. If it's negative or if it's positive, you add it to the fair value, and then you're going to have the total investment in associate, which you're going to post statement of financial position. Then other investments, right? If at all there are other investments, right? You know, for the parent, other investments, you include them there. For the subsidiary, other investments, you include them here. And then maybe if there's a loan that the parent issues to the subsidiary, or the subsidiary issues a loan to the parent, you need to deduct it here, right? Then number 6, you aggregate the inventory for the parent. You also aggregate the inventory for the subsidiary, and then unrealized profit, you deduct it here. So the way we've learned how to calculate unrealized profit in the statement of financial position is the same way we need to calculate the unrealized profit here. Then trade receivables, right? You've got the parent here, trade receivables. You add them to the trade receivables for what? The subsidiary. Again, remember in the statement of profit or loss when we're consolidating, you need to deduct the intra-group receivables, right? In the statement of profit or loss, we're deducting the intra-group sales from the total sales figure that have been aggregated. Then from the cost of sales, we're deducting the intra-group purchases. But in the statement of financial position, we are deducting the intragroup receivables. The receivables that have been given as they are owing at the point of consolidation. And then cash at bank also is simple. You just get for the parent, right? You also get for the subsidiary, and then you add cash in transit. So what does cash in transit mean? At the point of consolidating, at the end of the financial year, maybe a proportion of the payables that the subsidiary owned, for instance, right? Or that the subsidiary owed, the money has been transferred, but it has not reflected in the bank, right? So it simply means the payables have reduced. So there's a difference between the intragroup receivables and the intragroup payables. So that difference, right? That's the cash in transit. And then that cash in transit, you have to add it to the cash at bank. I don't know if you've got a question so far.
No, no question.
No question? Then we've got retained earnings. So retained earnings is the one with a bit of acrobatics here, but it's easy. You just get the retained earnings for the parent, right? And then what do? We need to add the share of post-acquisition profit here. So my apologies. I think when I was writing, I think I was in a rush or something, but it's not A here. So the share of post-acquisition profit here is the one that we found working number one here. This one. This B that we have here, right? That's the one that was supposed to bring here. So not A, sorry, but B. So this B that we found assets acquired upper, right? This B that we have here, right? So this B that we have here, right? So we get the post-acquisition profit multiplied by the holding of the parent. It's going to give us B. And then that B is the same one that we bring here, right? And then we also say the share of profit from associates, right? So this share of profit from associate is the same one that we have here in the investment in associates, yeah, person, right? And then after you add those, you need to deduct impairment of goodwill, right? So remember here, working number 2, when we're calculating goodwill, there was impairment of goodwill. So this goodwill is going to be deducted here. But the trick is this: you only apportion the impairment of goodwill between the parent and the parent and the non-controlling interest if the method of calculating the non-controlling interest that has been used is the full goodwill or the fair value method. If the partial goodwill has been used, right, the share of assets, the proportion of assets has been used, then you do not have to apportion impairment of goodwill. And then unrealized profits on trade with associates. So the unrealized profits from intragroup trade with the associates, you bring it there. Then impairment of investment in associates, you bring it there. And then unrealized profit on intragroup trade with the subsidiary, you bring it here. Again, the issue that you need to understand here, you only apportion if it's the subsidiary that has sold to the parent, right? If the subsidiary sells to the parent, it simply means the unrealized profit is going to be earned by both the parent and the non-controlling interest. But if it's the parent that sells to the subsidiary, it simply means the unrealized profit is earned by only the parent. This is something that you need to understand as well. And then there's also what we call unwinding discount, right? So this unwinding discount here, when we're calculating the goodwill for the value for the contingent liability, we divided by a factor of 1.10. Here, this is what we call discounting. So if you say 10,000, right? So if we say 10,000 divided by 1.10, it's going to give us 9091, right? So the amount that we need to pay next year, right, is 9091, right? Sorry, hello, can you get me?
Yes, again.
Yes. So we are supposed to pay 10,000 next year, but this year we need to record 9091, right? So we've discounted. So this 9091 is what we include here on the goodwill computation, like that, right? And then, right? And then you need to multiply this by 10%. So that's 10%, right? Is what we call unwinding discount here, right? And then you need to add it to the figures that we have here. So this is supposed to be a positive. And then you also have due diligence. You deduct. So what does due diligence mean? So when you're acquiring this business, right? So instead of you just going and paying, yeah, you first engage a company, a consultancy company, and then they review the performance of the business. They review the nature of the business, so that at least you can have an idea of whether to buy the business or not. This is what we call due diligence. Those are due diligence costs. So if there are any due diligence costs, you deduct. And then you also have equity, right? The parent. So this equity includes the parent ordinary shares. So for the equity, it only has to include the information relating to the parent and the parent only, right? So you get the ordinary shares for the parent, right? And then the shares that were acquired through share exchange. How do you calculate this? You say 1 divided by 3. If the proportion was 1 to 3, you multiply by 6. If the share price is 6, and then you multiply it by the number of shares, then you're going to have what you're looking for there. And then you also have share premium for the parent. Then you also include the share premium resulting from the share exchange. So you say 1 divided by 3, if that's the ratio that you've been given, right? Multiplied by the share price 6. And then you say the same 6 minus what you find here, you multiply by the number of shares, it's going to give us the figure that we're looking for here. And then you're going to have the total equity. So explaining it just like this, it doesn't make a lot of sense. But if we actually go through the question, it's going to make much more sense. And then you've got retained earnings. What are these retained earnings? These are the retained earnings that we found here. All right. We bring them there, and then the valuation surplus for the parent that you've been given in the statement of financial position, right? Even these ordinary shares, these are the ordinary shares that you've been given in the statement of financial position. In the workings for the retained earnings that we start with, these are the retained earnings for the parent that you've been given in the statement of financial position, right? And then here, lastly, you've got the NCI. The NCI, you get the fair value for the NCI. So the fair value for the NCI, where do we find it? The same fair value for the NCI that we calculated the goodwill, right? So this NCI that we have here, right? Whether you're using the partial goodwill or the full goodwill, right? You bring that figure there, right? And then that amount, you bring it here in the computation of the non-controlling interest. And then share of profit. So this share of profit, again, it's not supposed to be B, near per share of profit that you have from the assets acquired. So for the non-controlling interest, it's C, right? So that C that you have there, that's the same C that you need to bring here as the share of profit. And then a share of unrealized profit if it's a subsidiary that's sold to the parent, and then share of goodwill if the valuation of non-controlling interest, we used the full goodwill, which is the fair value method. And then you've got a loan here, right? If there's a loan, the parent, then you add the loans for the subsidiary. Then if there's any intragroup loans, you deduct them. Then for deferred tax as well, if you have got any deferred tax associated to the parent, you add it to the deferred tax associated to the subsidiary. And then you also add the deferred tax that you found in working number 1, right? So the deferred tax post acquisition deferred tax so, right? This deferred tax, that's the one we need to bring apart as part of the total deferred tax. And then if you've got any provisions, right, you include those provisions. And then contingent liability, a contingent liability here, you bring it, but you have to get the full contingent liability, right? So you get figure that you have more goodwill, right, which is 909, for example, right? And then you add the unwinding discount, right? Or in simple terms, you just get 10,000. You bring it to. That's if the payment is going to be made next year. But if it's going to be made in 2 years, computation cut up sana. But it's just the same, but you just power the discount factor to maybe 2 if it's 2 years. But it doesn't really make a lot of sense if I'm just explaining like this, unless we're going through a question. And then payables, the payables for the parent, you add them to the payables for the subsidiary. And then you also have intragroup payables like that, right? You deduct them. Current tax also, current tax for the parent, you also add the current tax for the subsidiary. So I don't know if you've got a question so far.
No, no, the question is just that they're not there. Yeah.
Okay, so next, after we've performed these workings, now we can comfortably prepare the statement of financial position. Right, like that, statement of financial position. Then you've got the quarter there and the quarter there. So the preparation of the statement of financial position is actually very easy. Uh, when you have carried out the workings, right? So if you've performed these workings, it's actually very, 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 very easy. So you've got the PPE here, the same PPE that we calculated. Working number 3, the goodwill, the same goodwill we calculated working number 2. Investment in associate, the same investment in associate to calculated working number 4. Other investments, the same other investments working number 5. So here what you're doing, you're just plugging in the totals that you find Kuma workings. Inventory, the inventory that you find working. Receivables, the receivables that you find there. The bank, the bank, the cash at bank, the same cash at bank that you found clear, and then you are going to find the total assets. Then capital, the ordinary shares, working number 10, you find it here. Share premium, the same share premium that you found, working number 10, evaluation surplus, everything that you found there, retained earnings, working number 9, you bring it here, you're going to find the total here. And then NCI, right? Non-controlling interest, the same non-controlling interest that you found today, you bring it here. And then you're going to have what's called the total equity, the number non-current liabilities, long-term loan, the same long-term loan that you found working, the deferred tax, the provisions, deferred consideration, contingent consideration, everything that you found working here, you're just plugging them in, right? Which also applies kuma payables, the current tax. So there's nothing new that you do. There's no computation that you do, apapama, like when you're preparing the statement of financial position, aside from just adding, right? But the work is kuma workings. Hello? Hello?
Yes, I'm here again.
Yeah, so yeah, we're basically done. I don't know if you've got a question
No, I don't have a question.
or clarification.
How? You? No.
Okay, so tomorrow we're going to go through a question. So early morning, we're going to go through a question. So our lesson has been concluded. I'll share the video with you. Hello?
I'm getting.
Yeah, so I'll share the video with you.
Okay.
Yeah. So please, you need to go through. That's the only way you're going to understand these things. All right. Good night.
Okay. Thank you.